Northern Beaches, mums, thank you so much for affording us your time this evening. We know that you are all very, very busy people, and we hope that we can share with you some information tonight that is going to make everyone a lot more aware as to what sort of criteria one should be looking for when investing in my name is Warren Jacobs. I'm the National Business Development Manager. I'm the one with the little hair on the photograph with the glasses. Sitting with me is my colleague and highly experienced property investment consultant, Jared Gauzy, who will go through the nuts and bolts of this particular presentation, and I will just do a sweet little introduction just to give you some idea of what to expect this evening. First, if I can put a disclaimer together, please, whatever you see here tonight, this is very general in nature. Do not go out and buy a property on what you see here tonight. Obviously, one would need to be able to know what your own individual circumstances are, and you will be given an opportunity to let us know whether you would like us to do that or not. So what we're going to cover this evening is we're going to give you a little bit about who we are and what we do. We're going to show you how we use analysis and the people that we use to analyze to enable you to maximize your performance, certainly to de-risk the situation. As I'm sure you know, every investment comes with certain risks. What we are able to do to negotiate the best prices for our clients, where and how to invest at the moment, what an actual client's Meridian matrix looks like on a past investor that has invested in 4 properties. And then towards the end, if anyone would like to ask any questions, please type in any of the questions you would like, and then we will hopefully be able to answer them for you straight away. So Meridian, we've been doing this is our 11th year, and as I mentioned to you, that we were talking purely about investment property. I don't think anybody right now would not realize in watching mainstream media coverage on what's happening to the property markets around Australia. 12 months ago, I think we were all, and CBA, Westpac, all the groups were forecasting some rather disastrous events in terms of the property, but as is always the case with global pandemics, it is important to be able to understand what generally happens to property when these things happen. And as you can see, the rebound has been absolutely massive. Now, there are a couple of reasons for that, of course. I mean, we've got the lowest interest rates we've had ever. The government has initiated some remarkable incentive schemes for new buyers and for first homeowners. And that has, obviously with a limited amount of stock as well going through the COVID, has really put the perfect storm together for property pricing to rise. But we are very much focused on investment property, and there is a massive difference between the owner-occupier markets and the investor markets. And what we hear in mainstream media and on the news and in the newspapers is the property markets entirely. And so it is very important to be able to distinguish, well, what's a good investment property? What's the difference between an owner-occupier property? So there are certain things that set Meridian apart from any other provider in this particular space, and something that we are unbelievably proud of. So we are the only property provider in this particular space that use an independent, unbiased panel of economic experts. And we meet with them 3 times a year, and we get the perspective on each and every one of their own specialities before we can come up with a macro and micro fundamental situation that Jared is going to talk you through very shortly. So the members of our investment panel are Rachel Logie and Sarah Hunter. Both of them are economists at BIS Oxford Economics. BIS Oxford Economics is, in fact, Australia's leading provider of industry research, analysis and forecasting services. Their analysis is underpinned by reliable and detailed market data, and the analysis of the developments come through thoroughly researched forecasts. That is, forecasts, not what is happening, but what they think is going to happen. Angie Zigamanis, who is the Director of Research and Strategy at Charter Keck Kramer, I beg your pardon, in fact used to be with BIS Oxford Economics and was voted by the Australian Financial Review as Australia's most accurate forecaster. Charter Keck Kramer They're an independent property advisory providing expert analysis, and they've been doing so for now nearly over 50 years. They're the leading provider of evidence-based property research and strategy. Cherry Rawnsley is the next gentleman you see on that on the screen in front of you. He's the director of KPMG. He's a renowned economist who provides advice to all tiers of government. I'm sure most of you would have heard of KPMG, but they are one of the world's largest professional service companies. They are present in 153 different countries, and their expertise really lies in risk analysis and management, as well as auditing and tax advisory. Timothy Fisher is the second last gentleman there with the glasses on. He's the Associate Professor of Economics at Sydney University. He really gives us a global perspective on what effects on events that are happening around the world and what effect that'll have on Australian property pricing. We very much look forward to catching up with Timothy the next time we do, which is going to be at the end of March, April, to get an understanding of what the lack of immigration has done. And we very much look forward to understanding what his take on that is going to be. The last gentleman over there is very important in the macro fundamentals, which Jared's going to walk you through shortly, because what BCI economics give us is an idea of every single development application that is in the system. So in other words, we are aware of how much stock is coming into any given area. That is something that the public will find very, very difficult to get their hands on. And may I say, with the greatest respect to Don, he charges like a wounded bull, but it is very important in anything in life to be able to understand what a supply is to a certain demand. It doesn't matter whether it's property, shoes, pens, it doesn't matter. If a demand outstrips a supply, the prices will go up. So what underpins our analysis and our research is really the findings and analysis of all of these economic heavyweights. And they will ultimately enable us to then understand what the macro fundamentals are and why all of those macro fundamentals need to be in place before we even start looking at a property. So without any further ado, I'm going to hand you over to Jared Gauzy, who will take you through those macro and micro analyses.
Thank you, Warren. A great introduction to the business. Absolutely, guys. Firstly, thank you for tuning in. We look forward to helping you guys look where we're actually helping clients today. We're going to look at some actual areas and give you some scope into why we're looking there. And I've been doing this now for coming up to 6 years, working one-on-one clients, helping them build property portfolios and using our research model to do so. We're after capital growth. We've seen what capital growth can do. Me on a personal level, I actually started investing in property in 2008. My first property was a one-bedroom unit on Pacific Parade in Dee Why, which I still hold today. I moved into Blacktown then, as in purchasing another property, a house. And then I purchased another one in Collaroy. And then I branched out to the Queensland market and secured 3 investments. And then basically that was the accumulation phase. I built a portfolio to get ahead. And then 5 years ago, I bought my house in Terrigal, which I love. I purchased it outright for my family and my 2 kids and my wife. And I used property investment to get there. So that's really what got me in this business, and I love helping clients. So thank you for tuning in. So what we look for, guys, we basically take a top-down approach, and we look, firstly, what state has the strongest fundamentals, as Warren pointed out. Then we look down to a city level, and then down to the specific suburb, and then we only start to look at property. Now, what we look at every level is the following. We look at the economy. And the easiest way, there's many different factors. We could talk about economics all night, but we will not bore you with that. Let's just touch on diversity of employment. And what I mean by that is we don't want to look to, say, a mining town or a tourism-based destination. We typically want to stick to your robust cities and then suburbs that have lots of different sectors of employment. That way, lots of people working there. If something happens to mining or something happens to tourism, it's not going to affect the market that we've invested in, because that area is diversified. Now, a diversified economy will also bring a lot of people, which is your population growth, and driving people to that market. That is pure demand for property. If 1,000 people move to Dee Why, 1,000 people are going to demand property. What we need to do later on is just make sure they're not building enough property in Dee Why, and that it's affordable. Now, infrastructure is crucial. Typically, the beauty of property investment in Australia is if you identify a solid suburb, what you'll typically find that is infrastructure is already in place. And 70%, so 70, of that suburb is actual homeowners. And that creates a lot of stability in that market. Because if interest rates go up or a pandemic hits once again, all those homeowners will do everything to hold on to their home. Now, if 70% of the suburb is homeowners, the other 30% is renters, which is investment properties. Now, not every suburb looks like that when you look through the census and ABS. The last thing we want to do is invest in a market where, say, there's 70 to 80% investment properties, because if interest rates go up, all the investors are going to quickly sell. It's the last thing we want.
I'm sorry, I just wanted to interrupt Jazz just for a minute. I mean, it has never been more critical in terms of what Jared has just mentioned. When you're looking at suburbs, highly desirable suburbs of Sydney, the inner west of Sydney, for instance, or even Bondi, where you have a very low percentage of owner-occupiers, and your renters are very heavily weighted towards, as we see in Newtown or the inner west, hospitality. So in areas like that, you've seen rents plummet, vacancies rise, because the renters are far too many. You don't have a 70-30% split there. You've got far too much rental property, and the renters are working in one sector or a couple of sectors. It's very important to understand what the renters do, and as Jared says, they work across different sectors of the economy.
Absolutely. Thank you, Warren. And the next fundamental we're going to look at is rental yields. And a lot of investors really aim to hit a high rental yield, and we do want a good rental yield that at least covers the rent repayments when we hold an investment property. But capital growth is more crucial. That is what's going to help us build wealth. If you hit a market that's 70% homeowners and the others 30%, the rental yield will be strong, and that will ensure that vacancy rates are typically low. So when I talk about vacancy rates, we're talking about empty rental properties in a market. Now, 3% empty rental properties within a whole suburb would be classified a balanced market. No real reason for pressure of prices to go up or down. Obviously, we want property prices to go up. So what we're looking for is a suburb that has consistently had vacancy rates under 3%, so 2%, 1%. That's what we're after. Anything over 3% is an oversupplied market, and that's what we're going to avoid. Now, the only issue with looking at a vacancy rate is it doesn't give you any forecast on future supply. Now, as Warren went through with our investor panel, we use core economists to understand how much property is being built in the future. And that will help us determine whether a vacancy rate can stay under 3% or will it potentially go over. Now, a big one, and this has improved especially as of recently, is availability of credit. People can get their hands on credit through the banks now, which is great. That's what's fueling the property market. We just need to be clever and then look at the next fundamental, which is affordability. And I'm going to take you guys through some graphs tonight of two main cities, and it's really going to show you whether that city is affordable or unaffordable. And what we need to do as investors is make sure that that city is affordable before we start looking at suburbs. If it's not, why would that area increase in price if people can't afford to push it up? So affordability really puts a cap on pricing. Once we've ticked all those fundamentals at a state, city, suburb level, we then look at the micro analysis, which is just as crucial, but we make sure the macro is in place first. Now, micro is looking at the type of property, for the demographics of that market, and then value for money. So that is the research model in whole. Now, I'm sure you've been waiting where to invest, and we've just gone through the why. So what we're looking at now is the property cycle. Now, typically we've probably all heard, and we've even seen it over the last 10, 15, 20 years, property markets will go through a big growth phase, and they used to coin the phrase that markets in Australia, good markets, will double every 7 to 10 years. Now, some markets have done that, I'm sure you would agree, but there has been plenty that haven't. So it's really up to us to help investors understand where we should be looking and whether the cities are at the top of the market, which we know we call it danger, or you hear about the booming market. If a market's been booming for 6, 7, 8 years, you've really got to be careful because it might go into danger and then go through a corrective period. Now, there's been times where Sydney sat flat for 5 years, and I'm going to go through that shortly. It was only a few years ago where Sydney sat flat for 2 years before the RBA came in and put interest rates down. So it's up to us as business to understand where all the cities are, and that will help us determine where we should be looking to invest. Now, This is where we believe things are positioned. We see Brisbane in value. We've helped many clients in the last 3 or 4 years securing property in Brisbane, and many have done really well. We've also helped our clients into the Canberra market. Now, Canberra and Hobart have done extremely well. They've been booming in recent years, like as long as 4 to 5 years. But we do believe it's starting to get up there when you look at the prices and what you receive for your rental return. Sydney, we do believe, is coming up to a danger point. The expectations is for Sydney to grow in the next 10 months. But what we're going to take you through is the likelihood after that next 12 to 18 months. We really do want to make sure we're entering a market that has the ability to grow for the next 6 to 8 years, because that's going to give us the best possibility for ongoing, consistent returns on our investment. Now, Darwin, we do believe, still in danger. Adelaide and Perth look very affordable, but they've just been sitting in correction for a while. We're not seeing strong interstate migration to those areas, so there's just some lacking fundamentals there. But we will keep our eyes on those areas. Tonight we are going to focus on the Brisbane market as well as South Coast, so regional markets. And Nowra is a major city that is receiving a lot of infrastructure spending. We're going to go through that too. So South Coast and Brisbane is definitely some areas we believe are strong for investment opportunity. And we're going to go through exactly why that is. Now, first of all, Sydney, and why we are not recommending Sydney right now. Like we said, we are looking at regional, so anywhere within 2 hours of Sydney, and a key reason is this fundamental here, is affordability. Now, if you look at this chart, basically from 2009, actually when I got started was 2008, people were spending about 25% of their incomes on the mortgages. Now, that's an affordable state for a city, and that basically typically tells us that the city is in the opportunity phase of the property cycle, and it has the ability to grow for the next 6 to 10 years potentially. And that's exactly what it did. From 2009 to 2017, the market did 98% growth as a whole. Many suburbs did a lot more, some didn't do as good. Now, after all that growth, basically doubling over that period, it got to the point where people were spending 41% of their incomes on the mortgage repayments, and that's very unhealthy for a market. So that sent the market through a correction, and it sat through a correction from 2017 to 2019. Beautiful, excuse me. And then what we saw there was a decrease in pricing of 18%. The market dropped, and it was based on that affordability. If you're looking at those statistics, you know it's not the time to buy. If you hold an asset, that's okay, but it's not the time to buy. Then as it was correcting, it dropped 18%. And then what happened is the RBA came in, and we saw the pandemic, which happened 12 months ago. They lowered interest rates further. They brought in more government incentives to help buyers get in the market, and that improved the availability for credit. Now, that's exactly what we're seeing. And what we've seen in the last 12 months is basically the market now only dropped at 9%. So it's improved a little bit, but it hasn't even regained what it lost from 2019. Now, what we look at as a business, okay, the forecast is for Sydney to grow in the next 12 to 18 months. But what we're looking here and taking real close eye on is how much are people spending on mortgage repayments, excuse me, and they are spending 35%. Now, that is very close to the breaking point, the 41% that we saw previously. Now, if we date back even further from 2004 to 2009, so a 5-year period, when it got to 38%, Sydney sat flat for 5 years. And what concerns us is that interest rates are at the lowest they could ever be. Can they really get any lower? So if they go up a little bit, that 35% will go up. So we are avoiding the Sydney market for now. We want to see that affordability really returning, get back down to that 25% mark. Now, when we look at a city as a whole and look at Brisbane, the affordability is quite strong. What we saw from 2001 to 2008, when people were spending 18% of their mortgages, 18% of their incomes on mortgages, it was extremely healthy. And we saw the Brisbane market do 178%. Now, the breaking point for Brisbane was 36% of disposable income on the mortgage repayments. And then it sent the market through a correction. It actually kept growing. It did 26%. Not a lot, at its correction period, which is what we touched on earlier in the property cycle. Now, As the market's sat relatively flat, what has returned is affordability. And what you see here is people are only, as of today, 2020, only spending 19% of their incomes on mortgages. And it's clear as day when you compare it to Sydney as well. People are spending 35 there. So what this represents to us is that Brisbane is really, some markets are in that value stage, but there's plenty of pockets of Brisbane that are in the opportunity phase of the property cycle. And based on these statistics here, the market has the ability to increase for a prolonged period of time. So for the medium term, which can be typically 6 to 8 years. So we've got a lot of faith in the Brisbane market. Now, what are the major banks saying? What are they forecasting? Obviously, we're seeing prices accelerate all across the country right now. And if we look at Brisbane, because we're just touching on that, in 2021, what they're really expecting is about 10% growth. And that's from NAB. And then in 2022, what they're expecting is 6.3% growth. So major shift in pricing in a very short period of time. ANZ is also forecasting Brisbane to be one of the top performers, as well as CBA and as well as Westpac. Westpac is actually expecting 10% within this year, which is huge, and then another 10% in 2022. So, hopefully our investors in Brisbane receive that. That'd be lovely, and we hope to help many more investors moving forward. And we really do hope to see these kind of gains. Our focus is just targeting markets that have the strongest affordability in place, are undersupplied, and have the ability to hit these type of figures. So as we've been touching on, Brisbane is definitely a focus for us, as well as regional New South Wales. And a big part of it is Sydney is really overcooked. It's overpriced. A lot more people are working from home now due to the pandemic. It's really changed things up in the last 12 months. I mentioned earlier, I live up in Terrigal. That market has basically doubled in the last 5 years. So the Central Coast did really well on the back of the migration, and it's becoming even more apparent with the change in how people work. But where we see the most value is, we're becoming late to the party in the Central Coast. I purchased 5 years ago there. We believe it's, the affordability is becoming strained there as well. We're seeing it with auction rates up there. But if you head down south, and that's where we're going to focus now, really it hasn't had the same amount of growth in that short period of time. So we believe it has the legs to go for a lot longer, and the rental returns you're getting are much healthier. So it cash flows your property for day one. So our focus is the city of Shoalhaven. Beautiful little pocket. It's basically set between Sydney, Canberra, and not far from Wollongong. You've got many beaches throughout that area. You would know of the world famous Hyams Beach, which is very known for tourism. You've got Kangaroo Valley through there. It's a beautiful little pocket. And the major regional city within that pocket is Nowra, which is receiving a lot of funding. As we speak, it is receiving over $1 billion worth of funding. The Shoalhaven Hospital is a $600 million project, very similar to what we saw here in the Northern Beaches with their major hospital. That's up and running now and has had a really positive impact on the market here. It's a very similar project that's going ahead. They're fixing up all the infrastructure. There's the Albion Bypass, which is almost $1 billion project in itself. It is getting bottlenecked through that whole South Coast region. So they're trying to fix it up, the government and the councils, which is great. But what that sort of represents up to us is a lot of people are moving there. And then when we look through the census data, we're seeing suburbs throughout the Shoalhaven region that literally doubled in the last 5 years. So there is pockets that we are really hitting down there, and we believe they're very undervalued. And the population base as a whole is quite robust in itself already. So there is a lot of people moving there, but it's already a very robust, owner-occupied, dominant market with plenty of jobs in place too. Now back into Brisbane. Now the beauty of Brisbane is the amount of money they're spending on infrastructure dollars. They're spending double per person compared to any other city in Australia, which is huge. So a lot of money is going through these focal points here. And what we have is within Brisbane, they're learning from Melbourne and Sydney's mistakes. And what I mean by that is Brisbane's a young city. You've got 2.5 million people compared to Sydney's, say, 5.5 million, but it's growing at a rapid pace, especially interstate migration. A lot of people are leaving New South Wales and Victoria and heading to the Queensland, Brisbane market. So what we're doing is identifying where they're spending money on jobs, and there's 4 main focal points. You've got Chermside in the north, 10 kilometres from Brisbane CBD. You've got Carindale to the east. Then you've got Upper Mount Gravatt and Indooroopilly. Now, the beauty of these focal points is they're all anchored by major shopping centres, and they're building commercial precincts to create employment hubs. And what that does is it stops everyone migrating to the Brisbane CBD itself. Now, one other project I did want to touch on here is the Brisbane Airport. So it is now a non-curfew airport, which will be huge once migration and travel returns to normal, which it will at some point. Also, what they're doing is soon to complete. They've just cleared all the land, and they're building a commercial precinct at the airport itself. Now, currently there's 20,000 non-aviation jobs at the airport. Now, from this commercial hub that they're creating, they're expecting another 30,000 jobs over the next 20 years, which is huge. And that is non-aviation, so jobs at the airport. So what we're doing as a business is identifying suburbs that have good connectivity to the airport, to these employment nodes such as Chermside, and also straight into the CBD itself. Beautiful. Like I touched on, infrastructure spending is just huge. We're seeing basically in the Queensland Infrastructure Plan has allocated $49.5 billion in capital works over the next 4 years. So this is funding and projects that are greenlit, they're underway and going right now. Now the population base, like I said, I touched on, very robust, 2.5 million. But what's significant about Brisbane is the interstate migration and the amount of people moving from sister states and going into the Queensland market, and specifically Brisbane, on the back of all these jobs that they're creating. So it's definitely a marketing opportunity for us. Beautiful. The affordability is strong. I touched on this earlier. It's the same as it was back in 2002 before it went through that 170% growth up to 2010. So that gives us a lot of it gives us a lot of confidence moving forward. We're seeing decreasing supply in the market. So the vacancy rates are well under 3%, so undersupplied, which is exactly what we're after. And the rental yields are quite strong. So you can purchase an investment property in Brisbane and the rent will be covering the loan repayments and all the ongoing expenses throughout the year from the get-go. And that's what we want, because it's good. Obviously, we want to identify markets that have the ability to grow, but we really need to cover our basis and make sure, if the market sits flat, will that property look after itself? And that's what Brisbane's offering.
Just a quick note, sorry, Jazz, on the decreasing supply. I'm sure that anyone listening here today would have heard, God knows how many people talk about an oversupply in Brisbane, and that would be absolutely correct. But again, as you will always hear in mainstream media, is that they'll talk about Brisbane. There are different pockets of Brisbane. So inner city units in Brisbane have been in oversupply now for quite some time. And so you haven't seen any growth. There are plenty of pockets, as we were talking about earlier, in terms of having all the micro and macro fundamentals in place that have grown through this period. So when people are just go, oh, Brisbane's oversupplied, is ridiculous. There are certainly pockets which are oversupplied, as there are in Sydney. Jared was talking about a 3% balanced market in terms of vacancies. The city of Sydney at the moment is a 20% vacancy. I mean, that is catastrophic. Anyway, as you will.
Thank you, Warren. Okay, guys, now we're going to bring things to a wrap here. And what we're going to look at is really the big picture and why investors get into investing in the first place. And that is obviously to create wealth. I've done it personally. Warren's done very well with his property portfolio, and a lot of our investors have done really well. And I've been working side by side with clients over the last 6 years, helping them do that. And Meridian, coming into our 11th year, helping people do the same. So we're going to look at a matrix of 4 properties and what 4 properties can do for an investor over a 10-year period. And it can really bring in some strong results. So this is actual Meridian Australia properties that we've helped investors secure over the years. Now, back in 2012, the fundamentals were strong for Marrickville. We did a lot of Sydney properties on a personal level, but us as a business, we helped many investors. Now, the purchase price here in 2012 was $445,000.
There's 2 better, by the way.
2-bedroom unit, worth much more now.
Yeah.
The smallest amount you'd be able to put into this is a 10% deposit. So your equity position, your net worth would start here at $45,000. Now, Moving forward, we helped investors in 2013 in Parramatta. It was one of those sister cities, similar to Chermside in Brisbane. It was being created into a huge city in itself, which we see today, correct? Now, the purchase price here was $450 for 2-bedroom units. Now, what I want to take note of here, guys, is if you take note of Marrickville from 2012 to 2013, that property price there increased 50 grand alone in that 12 months, which is huge and great for our investors at the time. Now, another 450 purchase here. What we see here is our equity position is 95,000 after a fairly short period of time. In 2015, and just showed some different diversity of our investment options that we help clients secure, we could see that obviously Sydney was coming up to a correction not long after 2015. The affordability was really becoming strained, so we entered the Queensland market. Now, we help people secure 3 to 4 bedroom terraces in this market. Mackenzie, very close to the Brisbane CBD, it's done extremely well. And the purchase price at this point in 2015 was $520,000. So what I want to take note of here too is we've actually taken a year off here in 2014 because we do understand investors aren't always ready to go every year. But what we do is touch base with our clients every 12 months. If they've invested with us, we send a report with actual sales, so we can basically look at the matrix of that individual investor, that Meridian client, and just basically touch base with them and see, are we ready to look at other options, looking at growing your portfolio? If not, we'll be touching base again soon. Now, what we have here from 2012 to 2015, the equity position has gone from 45 to 95 to 288 to 366,000 in a very short period of time. So it really does highlight what property can do if it's done correctly. Now, Win and West, this has been definitely one of our strongest performers in the Brisbane market. This was 6 houses that came available. We used our investor network to secure 3 of them, and we used that. Basically, we basically got the prices down because we were going to help 3 investors take 3 properties. We just had the vendor bring down his pricing, and we did really well. And that was great. We secured property here for $500,000 for a 4-bedroom generous block house, brand new. And if you were looking at houses selling in the market brand new at that point in time, you're probably looking more about the 530 to 540 mark. But because we took 3 investors at once, we just had a bit more negotiation. Now, at this point, even if one of our Meridian investors secured these 4 investments between 2012 to 2016, the potential equity position here would be $467,000 by 2016. So really good. And this is what we call the accumulation phase. Now, typically that's the first 5 years from when an investor starts. Sometimes longer. It just depends on your appetite for opportunity and risk. But we touch base with clients every 12 months to see if you guys are ready to take action and keep growing your portfolio. Now it's just basically from here is time in the market. So if we map out basically what we see here, 2017, 18, 19 are actual numbers. And what you will see here is, if you just look at the top one in Marrickville, 650, 630, 620. So it actually dropped. And that's because it was the Sydney market, which we knew that correction was coming. Same as Parramatta, 669, 635, 610. Now, what I would like to highlight here is that they've actually, it isn't major drops there, which is good to see. And that's because they are robust markets, very close to the CBD itself, which is good. So even though it's going through a correction, we're not seeing plummeting massive drops in prices. It's more a stabilization. Now, if we take note of 2017 to 2019, what we saw is the Brisbane properties increasing in value. And that's why it is so crucial us investors to really take our blinders off and look across the country with what's happening with the fundamentals and where is each city sitting within its property cycle, because they're all going at different points.
No, absolutely. And then, as Jared mentioned a little bit earlier in terms of the diversification, there are a couple of reasons for that, really. We've all heard the expression, you don't want to have all your eggs in one basket, but there are a couple of reasons for that in terms of property. As you saw, each city moves at a different time in the cycle. And you've also got to be aware that there is this threshold on land tax. So, I have plenty of investors who are obsessed with Sydney who have $60,000 a year tax bills. So having that diversification is not just a case of when is the clock right for me to be using this property as opposed to that one, but also to be aware that there are land tax issues which can be very, very, very expensive.
Absolutely, great point, Warren. Now, guys, to finish up this matrix, if we look at 2020, what we're seeing is that properties positioned here: Marrickville at 690, Parramatta at 650, the Mackenzie 630, and then looking at Wynnum West, looking at about the 670 mark. Now, from there, it's just forecast. But at that point in time, as of today, or the end of 2020, we're looking at that portfolio sitting at about the 775,000 mark, which is quite robust, very good outcome for a client that secured 4 properties with us during that period. Now, moving forward, we just put 5% growth for 2021 and 2022, which is conservative based on the forecasts that are out there, but it's always good to be conservative when mapping out these numbers. But if we do get 5% across all 4 properties here in this year and next, this investor would potentially be sitting over $1 million in equity just in 4 properties alone. So very powerful. It's what got me into property investment, and it's what gets many investors to do so if done correctly.
Now, just on the subject of it being done correctly, there is an awful statistic when it comes to property investors, and that is that 75% of investors only ever get to buy one. That is an enormous failure rate. And I think that if you looked at when we were doing the macro fundamental triangle, where we got our panel at the top end of the game, and then right at the pointy bottom end was the property. And what you'll normally find is that an investor will buy the property first, when really the property comes absolutely last. And you must allow the research and the numbers to do all the talking. This is not a time for emotional purchases. This is a decision for your brain, but it must be emotional for the right type of renter and the right type of purchaser who's going to come on down the line. That's the tricky bit.
Absolutely. Thank you, Warren. Okay, guys. So how to invest well? It's all about market selection, as we've gone through tonight, and it's also about the negotiation power, which I touched on earlier. Like we did those houses, we took 3 of them for our investors, which allowed us to get under market value, which is very important. The fundamentals, look, for a strong investment-worthy market, they need to be correct. You need a low supply, you need strong fundamentals in regards to population, employment, everything we've touched on this evening, and that market needs to be affordable. So even if the forecast for Sydney is to do 10% in the next 12 months, let's look further forward. Let's, can it keep growing for the next 6 to 8 years? If not, based on statistics around affordability, maybe we shouldn't look to the Sydney market.
And yields. I mean, the yields in Sydney are very, very, very low. But anyway, just very quickly before we wind this up, I'm sure that everybody, and I do hope that you're all sitting there with a cup of tea or a glass of wine. But just in terms of wanting, in the next slide, you'll be able to get in touch with us if you would like to have Jared have a chat with you. Now, please know in that first meeting or the first time we speak with you or meet with you, that is purely a fact-finding process. There is no property discussed. It is imperative that we understand what your investment needs, what your investment wants, what your budgets are, and what you are aiming for, and we will then be able to do a very conservative, using conservative assumptions, give you some sort of cash flow as to what this would really look like. It is not a sales meeting. It is purely an opportunity for you to find out a bit more about us and for us to find out a lot more about you.
Absolutely, guys. To give us a chance to get some information about yourself. It'll be great to hear what you're looking to achieve, and we'll be discussing, how we can potentially support your investment decisions. Look, there's ongoing support through the entire process. So from looking into the markets to getting in touch with property managers, if you need accountants, mortgage brokers, whatever it may be. We've been working with some of the best in the business over the last couple, now coming into our 11th year. And look, our service is complimentary. So you won't receive a fee from us. So we look forward to catching up with you guys. Any questions you may have, please feel free to reach out. What we've got here is a QR code. We'll leave it on the screen for a little while. If you scan that, that will allow you to book in for a meeting. If you'd like to reach out, we've got our info here. Feel free to jump on our website too. but info@meridianaustralia.com.au. That's our phone number as well. But look, we hope you took a lot of value out of this evening. There is a lot of opportunity out there, but it needs to be done right. The first step is just sitting down and going through your information, figuring out what you can do, and then looking at some research and making the decision when you're ready, and that is if you're ready. Well, thank you for this evening.
Is there you must forgive me because I'm not very good with this technology stuff, but is there a chat box that somebody can write questions in or not?
Yeah.
If there are any questions, I do believe there is a little chat box. You can write a few questions in, I think. No? Or is there a comment there? Is that a comment? Comment? No?
That might be.
Oh, okay. Go back to the.
Yeah, that's all right. I'll go back to the chat. We'll leave that there for about 5 minutes, guys. Once again, thank you. Have a good evening, and we look forward to touching base with you guys all soon.
Yeah, thank you so much. Thank you also, Nicole and Naomi and Maurice, for organising all of this for us. We hope that we have left you armed with a lot more valuable information as to what one should be looking at when you're talking about an investment property. This is about making money, not about whether you like the tiles or whether the bath is in the right place. This is about making money. So if you would like to be able to have a chat with Jared, please reach out either on that email address or on the QR code which you can see on your screen, and then we would love to be able to have an initial chat to see if we're a good fit for you or not. Have a lovely evening, and thank you all again for your time. Take care.